Today we're going to talk about position sizing, knowing your edge, and we're going to review yesterday's trades. Stay tuned, traders. We'll be right back. Good day, traders. I'm Stacey Burke from Stacey Burke Trading. Already have had a very strong start to the week. And just a reminder, I've just gotten off the phone with Pepperstone. The webinar for Thursday has filled up very quickly, but there are some spots left. They're looking at trying to add more space. Again, that's Thursday, 19:30 Australian Eastern Standard Time. That's 5:30 for me in the West Australian Standard Time. For those of you in North America, most likely if you're in the East Coast, it'll be 5:30 a.m. And for those of you, again, 9:30 GMT, I believe that is, but the link is right here below in the description box. Save your spot. I just got off the phone with Peter, and I could have talked to Peter for hours. He had some amazing stories to tell me about his own trading journey. Very insightful. I think what you'll get out of this, number one, is you're going to find out that no matter what traders are out there, where they're at, how successful they are, they all have stories to tell about some of the experiences and some of the painful learning that they have gone through to get to where they are. And I know I have had my fair share of that. I'm going to be talking about that on Thursday as well. But again, that's Thursday night, Sydney, 9:30 Sydney time, and 7:30 Sydney time, 5:30 Australian Western Standard Time, and 19:30 Australian Eastern Standard Time. So today we're going to go and look at yesterday's trades. I'm going to show you the trades that I took, why I took them, and we're also going to look at each one of the British pound crosses and the euro. We're going to talk about the setups that occurred on those pairs. Thank you to my mate Sanj for giving me some insight in going over those and showing specific timings and entries. Just to review again the 12 candle system, the reason why that I narrow that window down, and just to clarify, that 12 candle window allows me the insight to identify the high and low from Asia or the day itself. But as the week evolves, I'm looking at Friday's high or Thursday's high, whatever range we're trading inside of, because now we're looking at the current high of the week and low of the week as that range expands. So we may be inside of a previous day's high and low, but when Monday starts trading, we're putting a high and a low in place that, as the week evolves, gives us our initial balance for our high and our low of the week. Now, obviously, the previous day's trading range is an area where, of course, there's going to be money, stops, orders, breakout orders, pending orders, take profit orders, all of those things. But every week, when the week starts again, we're at the beginning of the month, we could see three levels of drop against the trend for a continuation. We could see them work the high, or we could see a trading range stay above a major quarter level on those daily charts. We've had some significantly strong pound pairs moving, and we could see those continue as the next couple of days trade out. But again, the high and the low of the day. So coming back to that, people have asked me, what am I thinking as the day evolves? How do I know which way it's going to break? I don't know. All I can do is go by the same things that everybody else does, but I pay particular attention to when there's a high of the day in place, when there's a low of the day in place. And we're going to look at a couple of examples of where there wasn't a low of the day in place until just prior to the Europe-London window. Now that gives us some insight. Again, I talk about if you're getting filled inside. Now some traders messaged me telling me they took the 12 candle window trade in the direction of the move to the highs of the day. For me, that wasn't a trade setup. There's nothing wrong with taking that. There's a move in play, but again, I'm usually waiting for the market to move to the high or the low of the day, or 25 to 50 pips outside of that Asian range, depending on what time that move has started. So for me, when London, if it's already moving, London to me is in the middle of the range. If the market works into the low when London opens and gives me a pin at the bottom, then I'm looking for the buy. But if the market breaks out and pulls back and is continuing inside of the range, if I am ever inside, I need to trade in line with the peak formation that is already in place. For example, a low of the day or a high of the day. But when London opens, if I'm inside, I need to trade in the direction of that move, which typically may be a stop hunt itself to the high or to the low. I talk about the importance of that middle hour, the equities open. The equities market open in the London and the US session can often be a move taking traders to the extreme, which in itself is a stop hunt, but it gets traders chasing that momentum. We talked about those 3 bursts. There was a couple of textbook perfect examples of 3 push patterns yesterday, which were still good trades for traders to take, but we saw also the 100 pip, 85 pip, 65 pip move down fast, taking out the lows of the day. So those trades came off of numbers. And again, I look at the Asian range. So coming back to that original question, what do I see or which way do I think they're going? I pay particular attention to the numbers to see if the Asian range is encapsulated inside of a number box, a 25 pip or 50 pip box, or if it's trading around a round number. Because again, I'm always looking to see where the 50 pip box potential is, and that can come back to the previous day's high or the previous day's low. It's a dynamic, evolving organism. You're constantly thinking timings, highs and lows, the pattern of the trend, round numbers. It's all together at once. And then of course, engulfments, locking in the high or locking in the low of the day, and a pin hammer will often accompany those, or in an extended move or a shortened W, shortened M, we may see that on a second leg as the confirming entry candle, either at the end of an hour or the beginning of an hour in that Europe-London window and in the New York session. And from that point, we want to trade management. So one of the questions I got was regarding a trailing stop. So one of the traders mentioned that they moved part of their trade, they took part of their trade off and they had a trailing stop, and they sometimes got stopped out. I do not use trailing stops. I've talked about when I'm in a trade, if it moves to the high or to the low or to a round number level and it's around 40 pips, if that market spends more than 30 minutes there, I will typically exit the trade. If that market doesn't move through strongly or move through that level, it can reverse and come back, and I want to try and lock in at least 40 pips in a move. Now yesterday was an example of when they reversed and came off the highs of the day, and we'll go through this in a minute, was where instead of going for 50 pips, those markets had potential for more in terms of a measured move, but also I adjusted my profit targets off of the quarter levels in case the market pinned there. I used the spread plus the numbers as my exit price. So I was able to trap more than 50 pips, 65 on the pound yen, 85 on the pound New Zealand. Now they moved further than that, but also they did reverse eventually and come back. And I was happy to just trade that out, take more than the 50 and walk away. Then review, assess, and improve. Now there was certainly a way I could have entered better into the pound New Zealand. I got a little bit of a poor late fill, still a good trade, but again, how could I have improved that? I probably could have, I'm happy with the exit, but little things, give yourself a report card, assess how you could have traded that better. Each day when I come to the market, I focus on I call it day one. And I was rereading Alexander Elder's book, Trading for a Living, and he talks about comparing trading to being an alcoholic. When you understand, and no offense to alcoholics, it's more about understanding that sometimes when you're in trading situations, you don't recognize that losing is what destroys most traders' accounts, their confidence, their ability to be consistent, all these little things. And when you've blown up trading accounts and you've done a lot of damage, and I've talked about this before, you either walk away and you have to give it up, or you figure out what your solutions need to be and you work on them. And if you've ever done a lot of damage and you've had a few days to recover from that, you always come back and you focus on the basics and you look for the best trade setups. So every day when I go to the screen, I remind myself of that in terms of risk management, my best trading setups, my profit targets, instead of hoping for more or being greedy, whatever. I'm realistic about what my profit targets need to be based on the setups, and then you execute to the best of your ability. And I focus on day one good trade every single day, because Peter Brandt says it best: you're only ever one trade from blowing yourself up. You could make $10 million and you could blow that up in 2 or 3 really bad mistakes. And I've heard recently a trader who said he lost $27 million. Next question was position sizing. Now, one of the biggest things I'm going to emphasize before you worry about position sizing, either trade. Personally, I don't like to not trade. When I was learning, I believed in trading with real money. I wasn't big on using a demo account, because we've all done this before. We've traded demo. You put in 100 lots and you look at all the money you can make, but you forget about the ones that blow out the demo account and everything else. It has no real meaning, value to me. So I always, as I was learning, traded. I talked about this before, using a micro lot every single day, trading, figuring out what I was doing wrong, if I was consistent, and I knew deep down on a lot of levels where my inconsistencies were, which were more on my self-management side, and my true lack of having a real edge, because I was taking these other piker trades and mixing different systems because I was convinced I knew so much. But position sizing, to me, you need to build that through performance and through discipline and time over producing the results. So, my simple system, that's what I trade. That's what I do. I've personalized it to myself, knowing where I'm fallible, and tweaking everything based around trying to eliminate the human error factor out of that. So position sizing to me is, you start small, you grow that account, you preserve your capital, you protect it, you learn how to manage your risk. Then you add a bit more size and you do the same thing. You review, you assess, and you improve. You grow that account through your results and through your performance. Position sizing, even risking, how much do you risk? So there are certain trade setups based on the Monday, Tuesday, Wednesday, Thursday, Friday trades. As the week evolves, as the template evolves, there are certain trades that I will keep smaller, but other ones, when I know we may be in a level 2 or day 2, level 2, a trend move, a squeeze for maybe 100, 150 pips, where my downside is tightly controlled, I'm prepared to take more risk on those trades. Bigger size, because they're the ones that are like a bow and arrow. When they go, and they don't come back. They go all day. There's no stress, there's no heat, but those are the trades that I've learned will grow my account. The other ones are they're good trades, but there's still possibility of them maybe being stopped out or getting in early. I've tried to filter those out, but those are my smaller trade setups. My A+ trade, my large size trades are the level 2 trend trades. When they go, they go. So position sizing is something I believe you need to build through your results and through your consistency, and also knowing yourself, knowing that what you're doing is consistent, knowing that you're sticking to your process, knowing that you're not going to deviate and engage in irrational, impulsive, erratic behavior, revenge trading, anger trading, emotional things that will blow out your account. Coming back to number 7, trade management, self-management. Get in the headspace of treating your trading like a business, and that is the hardest thing for retail traders to do, because it's your own capital. Every trade has a bearing on you mentally, emotionally, financially. It's very important to treat your trading like a business. Okay, and next question, simplicity. I keep talking about, these are all the things I worked backwards in terms of understanding where my mistakes were, where we're deconstructing back in live time. It's one thing to have your system, but every day you get back at the screen and then you're you're sitting there and you're wondering, where's the trade, where's the trade? Everything I developed for myself was working backwards to take the guesswork out of it. And if I didn't see the setups develop in this 12 candle window, the hammer, the engulfment, the low of the day, the high of the day, in that middle hour especially, when the equity markets open up, 25 to 50 pips above or below the Asian range, if it's a stop hunt, whatever that may be, they were all there to protect me from, just because when the market's trading, chasing a move or guessing and then getting impatient and getting into the market. I'm all done with that. I know myself. I had to work out all those bugs, all the things that were the self-sabotaging behaviors. The technical side of the trading is pretty straightforward. It's usually the individual that interferes with the consistency and the results that we're after. So know yourself, know what your weaknesses are, your impulsive behaviors, your emotional swings, whatever they may be. If you're going on tilt, you know, that takes a lot of work, and it takes, I think, the daily routines that I talk about in the 7-step daily routine for high performance traders. If you haven't got it yet, go to my homepage, download it. It's a free audio file. Bulletproof yourself, your mindset, your habits, and your routines. That's what's going to help you develop the consistency. Keep crafting the behaviors, the technical approach, the emotional orientation that will help you create the longevity that you're after 20 years from now. Not this week, not today, 20 years from now. Be focused on constant progress so that you're still in this game in 20 years and you're getting the results that you're after, and you're producing the results in your lifestyle and in your trading. So your edge, what is your edge? Know what your edge is. I know what my edge is. I know what I need to do. That's what's important. When you work out the personal issues, the individual issues that you have, know what your edge is. You know, I talk about staying out of the inside. I've learned this. I've spent thousands of hours studying these markets. You know, and that's not to say that I know everything, because I don't know everything. But I know what I need to do to produce the results that I'm after. These markets behave the same over and over and over again. Nothing new is going to happen this week. We're going to see trades that are at the high of the day. We saw them yesterday. They're going to be stop hunts. There's going to be low of the day trades, high of the week trades. There's going to be trend trades. There's going to be engulfments. There's going to be pin hammers. And most of those will happen at or right near that 12 candle window, just before or after the equity markets open. So know what your edge is. Keep it simple. If it's simple, I can duplicate this every single day, pretty much on any market. And you know, I've crafted this on the currencies. I feel an intimate. I'm in touch with that market right down to the hour. And you know, this is where I've crafted my skills, and I know what my edge is. So we'll look at today or yesterday's trades. Again, the ones I took, the ones I didn't take, my reasonings for taking the trades that I did, where I got in, where I exited the trades, and we'll go from there. Have a great trading session. Remember, Thursday, again, the link below, there are some spots left. I'm going to see if I can get Pepperstone to maybe increase the audience size. Peter Anderson, absolutely incredible amount of knowledge, and he's going to share some very interesting stories, as he did with me this morning. So don't miss it. Save your spot. Have a great trading session. Keep it simple. Let's look at some setups from yesterday. Have a great trading week, and may the markets go with you.
Good day, traders. Stacey Burke from Stacey Burke Trading. We're looking at Monday, August 3rd on the pound Australian. I did not take this trade, but we'll walk through the sequence of events. I come to the screen towards the end of the Asian hour. We mark off our highs, and we mark off the lows of the Asian 12 candle window. Now, just to give you a little bit of insight, one of the things I do look at is the higher lows or lower highs inside of the range, because that gives me an idea if there's traders who have chased a move into the extreme or trapping volume. And also I look at the numbers. So we're in between 83.50 and 83.25. We're inside of a 25 pip box. The market moves right away at the first candle of the 12 candle window, which again, if you think of the hourly phenomena, these 4 bars form 1 hour prior to the end of the Asian window. And that in itself is an engulfment. It's an open drive candle. The market immediately moves up 2 candles to hit stops on traders that have shorted the market in the middle of that range. Breakout pullback, and then an engulfment on the last candle of the first hour as we head into the London Open. And that market moves aggressively to the high of the day. So again, we have 1 push from the low, 2 pushes taking out the high of the day. And again, timings wise, 1, 2, 3, 4, that 4 and first candle of the third hour now form our high of the London Open. High and low of the London Open. So we've taken out the high of the day. We're at the high of the week. We have 1 push, 2 pushes, a middle structure potentially in place. The market goes sideways and engulfs the pin at the high of the day. And then we get a second bull candle, which is the last grab at the money, getting traders chasing that move up after 1 push, 2 push, 3 pushes. And traders can either short the break of the bull candle. Some traders would have got in early on the bear candle or even at the high of the bull candle or at the numbers. Personally, for me, I would have been looking to enter in at the break of the bull candle, which is what I did on the pound New Zealand. But then that market moves aggressively back towards the low that was taken out just prior to the Europe-London 12 candle window. So some traders have taken the move off the low of the day. That's entirely their prerogative. That's an engulfment, breakout, pullback, continuation, 1 push, 2 push, and a third push with 1, 2, 3 pin engulfment, second grab at the cash with a bull pin, and then the bear candle to reverse the market, which is essentially the bear pin hammer to put the nail in the coffin, the break of the bull candle, and the 50 pip plus move through to the low of the day. Now again, following this through, the market engulfs at the low of the day. We get a similar setup, breakout, pullback, pin hammer on the first candle of the U.S. session 12 candle window for the stop hunt back against traders who shorted the move at the high of the day, and then the market goes into consolidation. Pound Aussie. Looking at the pound New Zealand now, similar but just slightly different. So we have the previous day's high. We have a lower swing high that could also act as a peak formation. And then we go into our Asian session. And you'll notice that this market stayed in between the 25 pip box between 97.25 and 97.50. This is a trade that I did take. This market gave us a high of the day when it came down in that second 3-hour window. Then it pulled up and continued down, giving us a lower peak formation high. So again, I talk about lower highs, higher lows that potentially can get traders chasing a move. That market goes sideways and gives us an engulfment at the end of the Asian window, and then similar to the pound Aussie, pulls back inside. So we now have a low of the day. Up until this point, as the market's extending out, we do not have a low of the day peak formation in place. Now I know that we have a low of the previous US session, and again, think logically about what traders are thinking that are shorting this market. They're thinking this market's going to go down through the low and hit the stops. They reverse this market, getting traders caught. The market stop hunts back inside, not extending down. It comes back inside. The move is inside of the range. So now these traders that are short are caught. You'll notice that in 3 bars, they've hit all that volume that's in that lower part of that move. Similar to the pound Aussie, we get a breakout pullback and then a continuation on that last candle of the first hour. But again, I'm looking at the low and the high. So some traders are trading inside of here. That's completely your prerogative. I think there's a misunderstanding that this move, even though it's a 50 pip move up, that I'd be trading that. That is not the trade that I'm looking for. I'm looking for something that extends down and gives me the pin hammer engulfment down low, or at the high of the day after hitting the stops. So this market moves 1 push, 2 push, and in my head, I'm thinking 1 hour, 2 hours. So guess what I'm thinking for the third hour? A 1, 2, 3, and I may get a trade set up at the high of the day. They hit the stops, they engulf this pair. Now I expected a higher push with the bull candle back up towards the bear candle open around the round numbers. It did not do that. At that point, I was faced with either getting in inside of the engulfment or trading the break of the bull candle. I talk about shorting bull candles in a down move or buying bear candles in an up move. And as it turns out, I ended up shorting this candle as it broke towards the low of the bull candle. I didn't get as good a fill as I should have, but I was satisfied at that particular time that I was in the right move. And again, you'll notice the higher lows. That's that 3 tiers of higher lows, which creates our stops to be hit on the way down. We had the previous session, US session low, and we also had geometry. So in my head, instead of 50 pips, when the market broke through the low of the day and then continued that move, this large bear candle convinced me that this move potentially was going to go at least 1 full quarter further. I put my exit order at 5 pips plus the numbers in case it pinned and reversed. I wanted to be filled as well at the same time, making sure I locked in a minimum of 50 pips from the original trade entry. So as that market went through, it obviously went a bit further. There could have been more, but that wasn't my concern. I was happy with an 85 pip move. This trade then came through, and you'll notice there's an extended stop hunt. It pulls down, pulls back, and then we get a 1, 2, sideways, 3, 4, and we get an engulfment, a 3-bar engulfment, and then the last bar of that hour engulfs the lowest bear candle. So we talk about the high bull and the low bear. Traders heading into the next US session 12 candle window potentially had an opportunity to enter this market after the stop hunt down low and the 4-bar reversal and the inside bear candle. That's probably more of an advanced trade for traders when they're ready, but again, the original trade for me was at the high of the day for an 85 pip move down. We're looking at the pound Canadian, and in retrospect, I actually think this was probably one of the better setups out of all the pairs. We had this strong vertical move down on Friday into the close, putting a peak formation possibly for the weekend. We had the high of the day in place from Friday. This market came down, working the low, working the low, working the low, before pulling back in the Monday rollover and giving us, we have the low of the day, but just coming back to our premise of 25 to 50 pips above or below the Asian range. The market was trading inside of a quarter range with breaking above 75.50 and finding lows at 75.25. So we had our high of the day. We had a lower high inside, which obviously trapped traders or had traders shorting the market prior to the stop hunt. We'll just adjust this. But again, just coming back to some simple concepts. The market hit the low, hit the low, hit the low, and then broke above it. Came back, hit the stops, hit the low of the Asian range before engulfing. We had a 1, 2, 3 down, taking out the swing high of the Europe Open, and then auctioning down, and the last candle of the second hour gave us a pin hammer if you were inside for the shortened W, which again, this was not an area that I want to trade inside of. But traders who did, thinking that this was possibly going back up through to Friday's high, the market breaks through the high of the day, at which point you'd be taking your stop to break even, hits the upper quarter level at 75.75 and goes into consolidation with an inside bar. So we're 25 pips above the Asian range. It's hit stops from the last swing down in the Friday US session, inside bar. The next bar, the first bar of the 4th hour, engulfs the high bull and moves almost 75 pips down. It is 75 pips through the low of the day before pulling back and hitting stops, and then working the low, and then pulling back into consolidation. So again, just coming back to some simple concepts. We're on a Monday. We've had a peak formation put in place from Friday's range. I talked about this. We were trading underneath of the last low before the high. The markets moved up, hit stops 25 pips above the Asian range, gone into consolidation, and then moved rapidly through to the low of the day. We're looking at the pound yen. This is also a trade that I did take yesterday. So in the rollover, we have a peak formation high from Friday. We'll just bring this back. The market auctions down, opens on a gap, and then moves up 1, 2, 3 levels, 75 pips in the Asian 12 candle window before giving us an engulfment. And again, I'm coming to the screen towards the end of the Asian session. We have a low of the Asian range in place, and already I'm thinking type 3 M formation. The market gives us a lower swing high, breaks through the low of the day before pulling back and putting pins up above the numbers. So I'm already thinking shorts because of the peak formation that's in place already at the high, and I'm thinking sell. We have profitable trades from the London session. Let's bring this over, bring that up. We can see the swing longs and then a vertical move on Friday. The market gives us an anchor point low in the Europe Open. Breakout pullback, pins going up to above the 50. One push, two pushes, and a third push, and engulfment potentially about to happen after the pin hammer. So again, I talked about selling bull candles in a down move, working into the low. We have our type 3 M formation at the low of the day. I entered in on the bear pin hammer on the break of that, and then the move that I was targeting, again similar to the pound New Zealand, I did a measured move, and again I put my spread plus the numbers for my fill price rather than just targeting 50 pips. I went for 5 pips off of the 75 level to get in an exit price at 80. This market then actually reversed and engulfed, almost 3-bar engulfment, but definitely the reversal off. And you can notice when we see these pins starting to form and then you get the big engulfment reversal and a consolidation on top of a bear candle range, we see the little bull pin hammer as we head towards the US session 12 candle window. This market, that trade was just over 65 pips. And again, just high of the day, low of the day. Type 3M formation, working the low, working into the low, working into the low. Pins up top above numbers. Bear pin for the continuation of the move down. And just looking at the euro, again, we had the previous day's low. So right away in the Asian session, they've triggered breakout orders. Obviously, other time frame traders have entered the market now. This could be profit taking, breakout orders, long entry orders at the equities open, bull pin engulfment. So there's traders now long in the market as well as shorts. So we got breakout traders in, we've got reversal traders in the market. As we head through towards the second 3-hour window, the market gives us an engulfment painting a new high of the day. So we have our low of the day in place with the Asian low, and we also have a swing high in place from the second 3-hour window. The market auctions down 1, 2, 3, not taking out the lows before engulfing. So again, we talk about traders who are holding on possibly for profit taking, that are short, holding on to this. They maybe have moved their stop to break even, or they're keeping their stops above their original position. The market pulls back, goes into consolidation. Then at the last candle of the London hour, we get the bullpin hammer, and that market moves up 25, just over 25 pips to hit stops at the redrawn high of the day. we get the inside bar and then the large spring candle engulfing the high bull as well as the inside bar, and then dropping down from fill from the previous day's low, 63 down to 00. So easily a 50 pip move down through the low of the day. Breaks out, goes into consolidation, then in the US session, hits it again, 1, 2, 3, sideways engulfment, bear pin, and then the same reversal engulfment back up in the long direction. So again, high of the day, low of the day. The market paints a high, paints a low. These swing traders are inside of the box. Traders who have shorted it and either not taking money off or gone to break even, the market moves back. As soon as we see a pin or a bull pin, that market in London now is moving back towards the high of the Asian session before engulfing and then reversing back down to the low side. So hopefully you got some value from today's video, traders. This is my edge, my approach to the market that I cultivate to try and keep, number one, protect myself, but number two, to give me an edge, number three, to give me some psychological consistency focused on timings, high of the day, round numbers, and the pattern of the price action when it reaches these levels. Stay focused, stay disciplined. Don't forget the webinar on Thursday. Have a great trading session, and may the markets go with you.
Hi traders, it's Stacey Burke from Stacey Burke Trading. If you haven't done so, please head over to my website at staceyburketrading.com. I create updates on almost a daily basis, and I would love for you to receive them. Just click on the blog. If you want to enter your name and your email address, I'll send you my free audio program, the 7-Step Daily Routine for High Performance Traders. This is essential knowledge for all traders in all markets, and this is for helping traders to master the market with discipline, confidence, and a winning mindset. I appreciate all your feedback and comments. As always, traders, stay disciplined, and may the markets go with you.